Welcome to Money Finance Wealth. Hello everyone, and welcome back to Money Finance Wealth. Today, we're focusing on a critical aspect of financial well-being, minimizing your tax burden legally and ethically. We're uncovering some commonly overlooked tax deductions and credits that could put more money back in your pocket. Before we dive in, if you're new here, please hit that like button, subscribe to the channel, and ring the notification bell so you never miss out on our in-depth guides to mastering your finances. We're all about providing you with the knowledge you need to build a secure financial future. Every year, taxpayers leave billions of dollars on the table by missing out on valuable tax deductions and credits. Whether it's due to complexity, lack of awareness, or simply overlooking certain expenses, these missed opportunities can significantly reduce your tax refund or increase your tax liability. In this video, we'll shine a light on some of the most common tax deductions and credits that taxpayers often miss, providing you with the knowledge and resources to maximize your tax savings. Before we dive into specifics, let's clarify the difference between these two tax-saving tools. Tax deductions. Deductions reduce your taxable income. The amount you save depends on your tax bracket. Example, if you're in the 24% tax bracket and claim a $1,000 deduction, you'll save $240 in taxes. Tax credits. Credits directly reduce the amount of tax you owe. A $1,000 tax credit reduces your tax bill by exactly $1,000. Credits are generally more valuable than deductions. Refundable versus non-refundable credits. Refundable credits can result in a refund even if you don't owe any taxes. Non-refundable credits can only reduce your tax liability to zero. You won't receive any of the credit back as a refund. These are some deductions people frequently miss. Health Savings Account, HSA contributions. If you have a high deductible health plan, you can contribute to an HSA and deduct those contributions from your taxable income, regardless of whether you itemize. Contributions grow tax-free, and withdrawals for qualified medical expenses are also tax-free. For example, in the current year, you can contribute up to the individual limit if you have self-only coverage, or the family limit if you have family coverage. Student loan interest. You can deduct the interest you pay on student loans up to a certain limit, even if you don't itemize. The maximum deduction is $2,500 per year. Self-employment tax deduction. If you're self-employed, you can deduct 1/2 of your self-employment tax, Social Security and Medicare taxes, from your gross income. IRA contributions, traditional IRA. If you contribute to a traditional IRA, you may be able to deduct those contributions from your taxable income, even if you don't itemize. The deductibility of your contributions may be limited if you are covered by a retirement plan at work and your income exceeds certain levels. Educator expenses. Eligible educators can deduct up to $300 of unreimbursed educator expenses, such as classroom supplies. Moving expenses. For members of the armed forces. Members of the armed forces can deduct unreimbursed moving expenses when relocating due to a permanent change of station. Credits offer a dollar-for-dollar reduction in your tax liability. Earned Income Tax Credit, or EITC, is a refundable tax credit available to low to moderate income workers and families. The amount of the credit depends on your income, filing status, and the number of qualifying children you have. The child tax credit is available for each qualifying child under the age of 17. The amount of the credit is up to the current year's amount per child. The Child and Dependent Care Credit is available for expenses you pay for the care of a qualifying child or other dependent so you can work or look for work. The American Opportunity Tax Credit, or AOTC, is for expenses paid for the first 4 years of higher education. The maximum credit is $2,500 per student. The Lifetime Learning Credit, or LLC, is for expenses paid for courses taken to acquire job skills or improve existing skills. The maximum credit is $2,000 per tax return. The Savers Credit is for low to moderate income taxpayers who contribute to a retirement account, such as a 401k or IRA. Energy credits include several tax credits available for energy-efficient home improvements, like installing solar panels or energy-efficient windows. Lastly, the adoption credit allows taxpayers to receive a credit for qualified expenses involved in adopting an eligible child. Homeownership comes with potential tax advantages. Mortgage interest deduction. You can deduct the interest you pay on your home mortgage up to certain limits. Property taxes. You can deduct your property taxes subject to the $10,000 SALT limitation. Home office deduction. If you use a portion of your home exclusively and regularly for business purposes, you may be able to deduct a portion of your home expenses, such as mortgage interest, property taxes, and utilities. Energy-efficient home improvements. As mentioned above, there are several tax credits available for energy-efficient home improvements. If you're self-employed, you have unique tax benefits. Self-employment tax deduction. As mentioned earlier, you can deduct 1/2 of your self-employment tax. Home office deduction. As mentioned above, if you use a portion of your home exclusively and regularly for business purposes, you may be able to deduct a portion of your home expenses. Business expenses. You can deduct a wide range of business expenses, such as office supplies, travel expenses, and marketing costs. Health insurance premiums. You can deduct the amount you pay for health insurance premiums for yourself, your spouse, and your dependents, subject to certain limitations. Retirement plan contributions. You can deduct contributions to a SEP IRA, simple IRA, or other retirement plan. Strategic charitable giving can provide significant tax benefits. Cash contributions. You can deduct cash contributions to qualified charitable organizations. Non-cash contributions. You can deduct the fair market value of non-cash contributions, such as clothing, furniture, or household goods. Donating appreciated assets. Consider donating appreciated assets, such as stocks, rather than cash. This allows you to avoid paying capital gains taxes. Donor-advised funds. As discussed before, donor-advised funds allow a streamlined plan for your donations and taxes. Volunteering. While time doesn't provide tax deductions, keep track of mileage. Do due diligence to make sure the place you are donating to is an actual 501. C3. In order to receive the tax donation, the place must actually be a valid charity. Good record keeping is essential for claiming deductions and credits. Keep receipts for all your expenses, including medical expenses, charitable contributions, and business expenses. Organize your records in a way that makes it easy to find them when you're preparing your tax return. Use tax software or a tax professional. They can help you identify deductions and credits you may be missing. When tax laws seem overwhelming, a tax professional can assist. A tax professional can provide personalized guidance based on your individual circumstances. They have expert knowledge of tax laws and regulations. Plus, they can give you peace of mind knowing that your tax return is being prepared correctly. Many taxpayers miss out on valuable tax deductions and credits every year. Speaking of guidance, we'd like to thank Finul Wealth Management for sponsoring this video. If you're looking for personalized financial advice and wealth management solutions, their team can help you navigate the complexities of financial planning.